Hey, John, thanks for the question. I know there's a lot of uncertainty right now with the Iran conflict and everything going on with that. So I thought I'd shoot you a video and answer your questions and explain a little bit about how I think about investing, managing the portfolio, and ultimately managing risk. So, as you pointed out, we're actually doing pretty well this year. So, right now, client account after fees is up about 5.5%, while the S&P 500 is down about 6.5%. So, that's about a 12% spread, which is pretty darn good. So I do have to say I'm pretty pleased with that. But that being said, could always be better, right? And so, why not go to cash? That's kind of your big question. Is okay, we've got this conflict, looking at potential recession, looking at war, volatility. The market's been coming down. Why not go to cash? So I have been thinking about that. Honestly, this morning I was considering moving a chunk into short-term treasuries or basically cash. Didn't, but it has been something I've been thinking about. And a couple of reasons why I haven't done that yet, and why I'm not sure that I'm going to, at least as of right now. And today is March 30th, 2026. So, first thing is a lot of times when people start to think about making that move, things are already priced in the market. And so the way the market works is, people are pricing in the future. And so you need to be quick to respond. If you're not quick to respond, the market's already reacted and you're behind. And that's why most retail investors, they buy at the top and they sell at the bottom, because once there's enough pain, once there's enough news, once there's enough talk, or they've thought about it long enough, is usually about the time when everyone kind of makes that same decision. And they call that capitulation. And so that's always something I'm trying to pay attention to. And if I'm going to make a move, I want to make it quick and I want to make it fast because I want to be early. Because you need to be positioned ahead of what happens next in order to really benefit from it. So partially is, am I late to the game? Maybe. But also things have been holding up better than I expected. There's obviously been a lot of back and forth talk between we're going to be done in a day, 2 days, a week, 2 months. Maybe we're invading. We could be here for 3 years. I don't know. So, there is that changing narrative around what the timeline is. But all things considered, for something like this, the market has held up fairly well. Before this happened, I was pretty optimistic about where the market was headed and still am through the remaining part of the year. But this obviously throws a big curveball. So the question is, do we need to start pricing in a longer term invasion and the full on war? Or can we look past that to what happens after that? And that looks like a pretty strong economy. So now, obviously, the big curveball to this could be if we have significant disruption from the oil industry and everything downstream of that that impacts the global economy. So that could lead to a recession significantly if we have massive shortages of oil and other related products. But we're looking at so far just a couple week kind of hiccup in the scheme of things. So that's the big question: is this sustained or not? If it's sustained, then yeah, we probably want to switch to more of a wartime portfolio. We probably raise some cash and go more directly into some of the assets that are performing better and likely to perform better in this type of situation. Now, why haven't I done that? Well, one, I'm not sure if it warrants that. And two, the thing about volatile times like this is that things go up fast, they go down fast. And when it comes to investing, you really don't want to cap your gains short. You really want to let those runners ride. And so that's part of this is we've actually done pretty well in some of these positions. So the energy sector, we have a couple holdings that are up, over 40% on the year. And we have a handful of others that are up, plus or minus 10%. And so, there are things that are doing well in the market. And so why be out of that, right? Now, when things crash, pretty much everything goes with it. And so that is true. But not there's always something, most of the time. There's usually something that's working. And I would rather be positioned for that versus just out. And so that's part of it is, cash can provide a good buffer. It can provide some stability, but it's also a great way to miss out on opportunity. And I would rather be more strategic about the investments that we're in and the sectors and the markets that are working well than just out entirely because I'm scared. And so, again, when things shift, it happens quickly. And I'd rather be better positioned to take advantage of that upside than, sitting on the sidelines and then missing out. Because then getting back in becomes even more challenging because once you've missed out, now you have to pay a premium to get back in. So all that being said, I'm not opposed to moving some to cash, but I definitely wouldn't go all in cash at this stage. And again, it's really about trying to find the opportunities that exist in the market, which there definitely are between commodities, energy, etc. They're doing pretty well. So hope that helps. Love the question, and we'll talk to you soon.